SCHY looks like the polite cousin in the income ETF family. Low-fee international blue chips quarterly payouts Schwab label on the box. But this is income autopsy, so we are not admiring the wrapper. We are opening the hood. Because a dividend ETF can look calm on the surface while its payout, its share price, and its long-term compounding story are all pulling in different directions. Today we are dissecting the Schwab International Dividend Equity ETF, ticker SCHY as of July 2, 2026. In plain English, this is Schwab's international dividend machine. It tracks the Dow Jones International Dividend 100 Index, which means it is built around 100 high dividend-yielding stocks outside the U.S. The fund sits in the foreign large value category, so the flavor here is not moonshot growth. It is mature overseas companies, dividend screens, fundamental filters, and low volatility selection. That sounds sensible, and in many ways it is. But the question is not just, does this fund pay? The better question is, what am I giving up to get that pay? Because income investing is rarely free lunch. It is usually lunch with a receipt taped underneath the plate. Quick but important, this video is for research and education only. It is not financial advice, investment advice, tax advice, or legal advice. It is not a recommendation to buy, sell, or hold SCHY or any other ETF. ETFs can lose value, and income funds can behave very differently from what their headline payout suggests. Distribution amounts, yields, holdings, prices, and fund documents can change, so always verify the current prospectus, shareholder reports, distribution notices, and official fund materials before making decisions. And if your situation involves taxes, retirement accounts, risk limits, or anything personal, talk with a qualified professional who can look at your full picture. Around here we do autopsies, not prescriptions. The snapshot is where SCHY earns some immediate respect. It is issued by Schwab, charges an expense ratio of 0.8%, pays quarterly, and has assets under management of $2,310 million. That is the profile of a large, established monthly income ETF. Except this one pays quarterly, not monthly, which matters if you are trying to match cash flow to bills. The low fee is a real advantage because every basis point not paid to the sponsor stays available to the investor experience. But the fund is still an equity ETF. It owns stocks, not a bank account, and those stocks live outside the U.S. That brings currency, country, sector, and dividend cycle exposure into the room. So the snapshot says efficient and diversified, but it does not say risk-free. This is a foreign large value income sleeve, not a magic paycheck printer. Now the part everyone clicks for, the headline distribution yield is 3%. The mechanical annualized figure from the latest payment is 4%. Those are not the same thing, and that gap is exactly why yield needs interrogation. The latest distribution was 36 cents per share, which is useful cash, but one payment does not tell you the whole personality of a fund. A quarterly payer can look generous in one quarter and quieter in another, especially when the income stream depends on dividends from international companies and according to the provided mechanics and options income approach. The key is to treat yield as a symptom, not a diagnosis. A bigger cash number can mean healthy underlying income, harvested option premium, capital being handed back, or some mix. The yield is the headline. The source of the cash is the story. The distribution history is not screaming growth engine. The first 4 average payout was 30 cents, while the latest 4 average is 28 cents. The stated trend is down from the initial launch period payouts to the latest 4 paid rows. That does not make SCHY bad, but it does change the way you should frame it. If you bought this expecting a rising paycheck every year like a classic dividend growth story, the trend asks for humility. International dividend funds can have uneven timing because foreign companies often follow different payout calendars and dividend cultures than U.S. companies. Some pay semi-annually, some vary more with profits, and currency can tug at the final result. So the distribution pattern here looks more like a lumpy income stream than a staircase. For retirees and cash flow planners, that means margin of safety matters. Now let's talk about the price path, because income without capital context is just a half-finished sentence. SCHY's latest net asset value and price is $32.07 versus a launch reference price of $25.83. Since inception, the NAV return is 24%. That tells us the underlying fund value has grown from its starting reference point, even after living through normal market stress. But the ride has not been smooth. The max drawdown is negative 25%, which is the part of the chart that tests whether an investor truly understood equity income. A fund can pay distributions and still punch you in the stomach during a sell-off. The NAV path matters because it shows whether the portfolio is preserving and growing the base that produces future income or slowly eating the furniture to keep the lights on. The distribution-inclusive picture is stronger than the price-only picture. SCHY has paid $4.86 per share in cash distributions since launch, and the simple distribution-inclusive return since inception is 43%. That is the proper way to judge an income fund, not just what did the share price do, and not just how much cash did it throw off, but both together. Income investors sometimes mentally spend the distributions and then judge the chart as if the cash never existed. Growth investors sometimes ignore the distributions and call a fund weak because the price line is not flashy enough. Both views are incomplete. The real question is whether the investor's total wealth improved after counting the cash. In SCHY's case, the cash distributions have been a meaningful part of the investor experience, not a decorative side dish. Here is the machine under the hood. SCHY tracks a modified market cap-weighted index of international high-dividend stocks selected with additional fundamental criteria and low volatility. Its top holdings are Wesfarmers Limited, WES 4%, Unilever plc Ulver 4%, NLSBA NL 4%, Roch Holding AG ROP 4%, GSK plc GSK 4%, and British American Tobacco plc BATS 4%. So the core basket is established overseas dividend payers, not speculative startups. The provided mechanics also describe SCHY as tied to an options income theme, using an options income strategy to generate large cash distributions. In plain English, that means the fund can collect option premium around its equity exposure, turning market movement into upfront cash. The trade-off is that income now can come with capped upside, distributions that may include return of capital and potential NAV erosion over time. From here, the checklist is simple but not easy. First, watch whether the latest 4 payout average keeps slipping or stabilizes. One quiet stretch can be noise. A persistent pattern becomes a character trait. Second, compare future distributions with the NAV path. If cash keeps coming but the base keeps weakening, the income may be less durable than it looks. Third, read the fund documents and distribution notices, because the label distribution does not automatically mean pure dividend income. Fourth, remember the foreign equity angle. This basket is exposed to markets, currencies, and dividend policies outside the US, so it will not always rhyme with a domestic income ETF. Finally, ask whether quarterly payments fit your actual cash flow needs. A fund can be perfectly reasonable and still be wrong for the job you hired it to do. My verdict: SCHY is not a cartoonishly aggressive yield trap, and it is not a sleepy savings account either. It is a low-cost Schwab International Dividend ETF with a real equity portfolio, a meaningful cash distribution history, and a risk profile that deserves adult supervision. The appeal is obvious: global dividend exposure, a modest fee, and cash payments that can support an income sleeve. The caution is just as obvious. Payouts have softened from the launch period pattern, equity drawdowns still show up, and any options income component means investors need to understand what part of the payout is earned, what part is premium, and what part may simply be capital coming back home wearing a dividend costume. SCHY belongs on the research table, not in the blind buy pile. The autopsy says, useful tool, but read the fine print before calling it income. 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment: which ticker should we put on the table next? And where do you think the real risk is hiding? We read everyone. Thanks for watching.